The government has announced a change in taxation norms for mutual funds. This was basically a part of the finance bill that got passed in the Lok Sabha. Please understand the change in tax norms is not just for debt mutual funds, it is going to affect other categories also, like, for example, gold funds, international funds, etc. So let's try to understand what is the announcement and what is going to be the impact of that. So essentially, in the case of mutual funds, especially fixed income or debt mutual funds, what used to happen was if you purchase these mutual fund units and hold it for more than 3 years, it used to be categorized as long term capital gain. And the advantage of making it long term was you will get something called as indexation benefit, which I'll explain in one of the upcoming points. What is the announcement now that has been made is very simple. Any mutual fund scheme which has less than 35% of its assets or its portfolio in domestic equity securities will lose the indexation benefit, which essentially means that it will be taxed as short term capital gain. In other words, there is no difference between whether you held these kind of schemes for 1 day, 1 year, up to 3 years, or even if it's for more than 3 years, the taxation part will be the same now. Now, you have to kind of understand what they're trying to say is that if a mutual fund scheme has less than 35% in domestic equity share, it is as good as a non-equity fund. And as a result, anything that you get from that will be treated as a short-term capital gain. Now, what happens in short-term capital gain is you add that gain into your normal taxable income. So if you have a business income, you have a salary income, you have different types of income, this short-term capital gain also gets added to that particular income and it will be taxed as your normal slab rate. So you have income tax slabs, right? Up to 10%, 15, 20, whatever is your slab rate based on your total income, you will get taxed at that rate. So if you are in the highest tax bracket, then any short-term capital gain from the mutual funds is now going to be added and taxed at your highest tax rate. Earlier, if you would have held on to debt funds for more than 3 years, you would have got an indexation benefit. That benefit is gone now. And effectively, the end result is that you will end up paying higher taxes on such capital gain. How much are those taxes? Let's see. So, a simple calculation before this amendment has been announced, the way a debt mutual fund taxation will work is let's assume you invest 1 crore rupees for more than 3 years is the plan. So you kind of decided that I'll invest for more than 3 years because I want to enjoy this indexation benefit. Let's assume the fixed income fund gives you 7% compounded rate of return. So you did not redeem it for 3 years. You held on to it. It kept on accumulating 7%. You got compounding effect, and the total value of this portfolio is now 1 crore 22 lakhs 50,000 odd, right? This 1.22 crores, which essentially means that you've made a gain of around 22.5 lakhs over 3 years, which is what you will get when you redeem after 3 years. So let's say you redeem. So redemption value is 1.22 crores. The gain is 22 lakh 50. However, because you held it for more than 3 years, you don't have to pay a normal slab rate on this 22 lakhs. What the norms used to give you was an indexation benefit, which means the income tax law said we understand that there is something called as inflation. So they will give you the benefit of time value of money and say, we will consider that your investment value of 1 crore is actually not 1 crore. In today's terms, when you actually redeem the money, in that sense, in today's terms, we will adjust or inflate your cost. How did it happen? There is something called as cost inflation index that is given from the income tax authorities. So let's assume based on that inflation index, which I have assumed as 6% in this example, which is that's normally the consumer price index number that we get. So this 1 crore will get indexed or it will kind of inflate at 6% compounded every year. So the cost of this 1 crore for you is now adjusted to 1 crore 19 lakhs. This is the indexed value. So what the income tax authority was telling you earlier is, I will not treat your gain as 22 lakhs. I will say your redemption value is 1 crore 22. Your cost, which is adjusted for inflation, is 1 crore 19, which means your actual long-term capital gain, because you held it for more than 3 years, is only 3 lakh 40 odd, which you see as this figure. So 22 lakh 50,000 gain you had made, but because of the indexation benefit you get on the cost, your gain is now only 3 lakh 40, on which you pay 20% tax rate. So that is also an advantage. Not only you used to get the indexation benefit, you also had a tax rate of only 20. If you're in the highest tax slab, you're at 30. So that 20%, the taxation is 68,000 rupees. On a 22 lakhs odd gain, you ended up paying a tax of only 68,000. So your post tax, you're getting around 21.82 crore, 21.82. I think this is 2 crore 18 lakhs essentially. And your compounded rate of return is effectively 7% compounded. 7% compounded is what essentially you got, because your 1 crore is now effectively 1 crore 21 lakhs 82,376. Now this has gone. Now what they're saying is there is nothing called as indexation. You hold it for 10 years also. I don't care. I will not give you indexation benefit. You will be taxed as normal short-term capital gain, which means you will be paying tax as your normal tax slab, which means now after the amendment, debt mutual funds taxation and fixed deposit taxation will look the same. Because in fixed deposit, this used to happen. You invest in fixed deposit, you keep it for even 5 years, you will still keep on paying tax on the interest as your normal taxable income at the slab rate. This indexation benefit used to be an advantage for debt funds, but that has not that is not the case going forward. Now, what will happen is your 1 crore 22 lakhs is a redemption value. 22 lakhs is your total gain, or 22.5. You will pay, assuming you're in the highest tax slab, 30%, 6 lakh 75. Your post tax yield is now just about 5%. So you can see that the difference of that 2% in your post tax yield in a debt mutual fund now, which is going to be the scenario going forward. So clearly, if you are enjoying the indexation benefit, it will not come to you now going forward, and there will be an impact of this 1.5, 2% or so. That is obviously material from a fixed income point of view. I mean, when you're investing to earn 7, and if 2% is affecting, it is getting affected, that's a lot of impact. Of course, I have not considered surcharge and cess, etc., in this calculation. Now, again, as I said, the proposal or the amendment is not about only debt funds. What they essentially said is any scheme which has less than 35% equity, no indexation. So not only debt funds, which obviously is less than 35% equity, there are some other categories also which gets affected, because this is domestic equity that they are referring to. So this is how it looks like now, just to give you a summary. If the mutual fund scheme has exposure to domestic equity, which is less than 35%, or 35 to 65%, and more than 65%. This more than 65% category was already there. It used to be always more than 65% equity or less than 65% equity was the equity classification. But now, because of this 35% rule that they have brought in, there are effectively three kind of compartments that you can call it. Now, which category of existing mutual fund universe will fall in 0 to 35% bucket is all the debt funds, right? So liquid funds, short-term debt funds, anything that you are talking about as debt funds will come under this, and no indexation benefit will be available now. Gold funds also come under this. So I think this is pretty much the end of gold funds the way we know. So gold ETFs, etc., will be, very, very unattractive now, because you don't really get any tax advantage. If you purchase a sovereign gold bond, you will get a tax advantage there, because if you hold it for 8 years, there is no capital gain tax that sovereign gold bonds will have. Also, you get a 2.5% interest on SGB. So in House of Alpha, we have always kept saying that SGB is the only way to hold gold. But this amendment in taxation will kind of make gold ETFs very attractive. So gold Bs and any form of ETFs are extremely unattractive now. International funds, which means you invest in NASDAQ, S&P 500, they have equity, no doubt, but they're not domestic Indian equity shares. So again, they will be taxed fully at your normal tax rate. There is something called as conservative hybrid funds. You have multi-asset funds, anything which has less than 35% equity. What the government is saying is we treat it as a normal interest accruing fund. And if interest on FD is taxed at slab rate, why should I give benefit to the mutual fund? So that is their logic. And now they're charging it at slab rate. Now, if the equity component is more than 65%, the extreme right, then you are treated as equity fund. And in equity, what happens is your long-term capital gain starts after 1 year and you get a 10% concessional tax rate. But there, even in short term, which is less than 1 year, your tax rate is only 15% because for a pretty long time in India, the budgets have always tried to create long-term wealth creation through equity for retail investors. So they've always given benefit to equity. So that continues. There is no change in that. Anything with more than 65%, you are still equity fund. So you have normal equity funds in that. You have your ELSS. You have other categories also like arbitrage funds, equity saving funds, aggressive hybrid funds. All that will continue. The taxation is same. Now, there is this mid category which has emerged after the announcement, which is 35 to 65%. So you will see a lot of action coming from the mutual funds in this category now. They will come out with NFOs, they will come out with new type of schemes in this category, which will be like a balanced hybrid fund. So what they will do is they will keep, let's say, a debt component of maybe 60-65%, an equity component of more than 35%. So they will ensure that the equity component is more than 35 and less than 65. So you kind of have equity, but not predominantly an equity fund. And there you will still have the same taxation that applied to debt funds earlier, which means you will have an indexation benefit for holding it more than 3 years. And you also have a 20% concessional tax rate. So there will be action in this particular category going forward. So any mutual fund which doesn't have a balanced hybrid fund in their offering, you can be pretty sure that they will announce it very soon. Also, they will all now start sending you a lot of information saying there's a lot of change happening after 31st March. So whatever investment you have to make in debt funds, please make it before 31st March. Now, there is a lot of discussion happening now that, oh, this means debt funds are killed. I mean, as a product, there is no need for debt funds and fixed deposit is the only logical thing to do. To be honest, I disagree. I think, yes, there was always an added advantage of debt funds because of indexation benefit. So if you're holding it for more than 3 years, your effective tax rate became literally nothing, as I showed you in the example. But that was the icing on the cake. That was like an added advantage that you used to get. Please don't forget the cake still is actually better than FDs. When I say cake, as in the debt funds as a concept, still is better than FD, is what I would think. Why do I say so? Multiple reasons. First is in FD, if you place an FD with a bank, and let's assume you're intending it to keep it for 5 years, a long term FD, let's say you're a retired person, for example, the FD interest will still be taxed every year. Whether you take it out, whether you don't take it out, there is an accrual based FD tax that you have to pay every year. So even if you don't take the money out from FD, even if you don't take the interest, you don't enjoy the benefit, you still have to pay tax. In debt funds, obviously, the capital gain will be taxed at short term capital gain only if you redeem. So let's say you keep on accumulating it and there is no need for redemption, then you don't pay tax. So the tax is still only on redemption, unlike in FD where even accrued income is taxed. In debt mutual fund case, there is no TDS. So in FD, banks are going to deduct TDS after a certain slab that has been given as a basic exemption for TDS. Uh, I'm not saying TDS itself is bad or it's like you cannot take a refund. If you're not supposed to pay that tax as per your ITR, you can always claim a refund, but then that's after you file the income tax returns. Initially, you will get the interest after the tax gets deducted, and later only you will get a refund. Now, again, if you're someone who's living out of this income, even that deduction of tax can hurt your cash flow. In that mutual fund, when you redeem, then only you pay tax, point number one. But that also there is no TDS. What they're saying is, I will give you all the gain. You calculate with your own workings, and then you pay the tax to the government later on. This is very important. See, they are not saying that debt mutual fund income is interest income logically like FD. They're saying it is still capital gain and it will come under the head called income from capital gain, which means the provisions of set off and carry forward continues, which means let's assume you have debt funds, you kept it for 4 years, you are hoping for indexation benefit, but you did not get it. And now let's assume that you redeemed and you got gain. In some other securities, if you make a short-term capital loss, for example, that loss and this gain can offset each other, which means that your overall tax impact could still be lower. FD interest cannot be, used to offset some losses in any other portfolio loss that you have made. So that offsetting benefit is still something that is available in the case of debt mutual funds. Don't forget the point of liquidity. So let's assume you invested in FD for 3 years, and after 6 months, you suddenly need that money for some reason. There will be what is called as a penalty, which means that if the agreed interest rate was 7% for 3 years in FD, the bank will say, no, 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 you did not keep it for 3 years. I'll reduce your interest. That was the penalty logic that we're talking about. In debt mutual funds, that is not the case. Let's assume you invested in a scheme which had a investment horizon logically for 3 years. The gain actually started accruing over a period of few months, and for whatever reason you redeemed. There is no change in whatever is the yield that you have enjoyed. That will not be deducted or something. So automatically, without compromising on your end returns, your liquidity will be preserved in mutual funds. That is something which always will continue. And that is also the reason why, if you see, the biggest category in the debt mutual fund space in the industry is liquid funds. Big part of the AUM is liquid funds, which is kept by corporates. For the corporates, it was always about liquidity more than anything else. That obviously will continue for not only corporates, but also for all of us, including retail investors. Now, I come to points which people ignore conveniently. Debt mutual fund is not just one product that works like FD, 3-year FD compared with 3-year debt fund, and that's it. There's a lot of choices available in the debt mutual fund space. So if I am an advisor, or if I'm someone who understands fixed income markets very well, there's a lot of interesting choices available in the fixed income offerings. For example, I want to invest for 3 years. That is just the duration part. So I have a 3-year FD also, but I want to take a little bit of extra credit risk. I'm willing to take that extra credit risk, for example, because I'm a sophisticated investor. I have that risk appetite. You may probably get a yield of 8-9%, which is not available otherwise in FD. You can't go to a bank and say, I'm willing to take more risk in FD, give me more. The bank will not obviously give you more. So there are choices available. I think specifically there are categories which I personally think is very, very useful to be added to a portfolio. For example, there is the high credit risk funds, right? So when I say high credit risk fund, relatively you can choose to have maybe a AA paper in your portfolio, and that could increase your yield if you want to take it that way. Second is we have a category called banking PSU debt fund. You keep the credit risk very safe, and then you invest in different PSU companies and banking bonds where the yield itself could be more than what the bank is probably giving in FD. So leave the taxation part. There could be potentially a 1 or 2% extra you get at a portfolio level itself, at a pre-tax level itself. Then we have this very interesting category called dynamic bond fund category, where there is active management of the fixed income portfolio based on both duration calls and to some extent credit calls. So if there is a good fund manager, and there are obviously a lot of them in the market, and if you're able to get those cycles right, you can actually earn alpha over any other fixed income product of maybe a couple of percentage points. So all those advantages are the cake. The flexibility you have from liquidity point of view, the fact that you have so much choices available for different risk profiles. FDs are same. Whether I'm a retired person or I'm a 30-year-old who wants to take risk in my fixed income portfolio, FDs will not give you a choice. Here, there is a lot of choice available. Most importantly, and this is very relevant in current interest rate context, is you can use debt mutual funds to earn what is called as capital gain, which is not possible in FD. What is it that I'm trying to talk about? Uh, as you would be knowing that interest rates have gone up over the last couple of years, right? Inflation has gone up, post-COVID recovery has been strong. So world over, and including in India, the central bank has increased the interest rate. So now RBI has also increased the interest rate so much that the FD rates have also gone up, as you would know, and the effective accrual income on the debt funds have also gone up. So let's take an example where currently, let's say it's around 7% for a 3-year kind of an FD or 3-year kind of a debt fund. Let's assume you're getting 7%. I am not even assuming that the debt fund is probably giving 8 over FD 7 because of the composition of their portfolio. But let's take 7%. Now, in the next 3 years, let's assume the interest rates go down by 1.5%, which is possible. Interest rates move in cycles. So we have seen a rate hike cycle. The next cycle could be a softening cycle. And let's assume over the next 3 years, there is a 1.5% cut in interest rate. Now, what will happen is in FD, you would still be happy. You'll be like, wow, I have locked in a 7% for 3 years. I can see the interest rates going down over a period of time, but I am still at 7%. So I'm happy. Awesome. I'm not saying it's a bad thing, but there is something better that you can get from mutual funds. In mutual fund, what happens is as the interest rate goes down, they're holding bonds and those bond prices go up. That's called capital gain. I'll give you a simple back of the envelope calculation. If you invest in a 3-year kind of a debt fund, it has a lot to do with the maturity, something called duration, right? So if you invest in a 3-year kind of a debt fund, and if the interest rate goes down by 1%, you have approximately 2.5% of capital gain that you will get, which means for every 1% change in interest rate, you will have close to 2.5% of capital appreciation for a 3-year maturity fund. If the maturity of the fund is, let's say, 10 years, there are long-term debt options available, right? There you can get something like a 6-7% capital appreciation for a 1% change in yield. Now, that means that if you hold a fixed income fund, the yields go down, the capital appreciation comes in, your effective returns may not be just 7, which you started at. You may probably get another 2-3% as capital appreciation. And overall, because the yield is also going down, you may get probably a 8.5-9% kind of pre-tax return. So at the pre-tax level itself, you may get a 8-9% returns in debt funds versus 7% in FD, and both are now getting taxed at the same way. So the pre-tax itself is a lot of reason why you want to consider debt mutual fund. So I don't think that just because of the taxation aspect is what debt mutual fund was being sold or it was being considered by anybody. It was an icing on the cake, definitely. But then there are times when you see a cake and there is no icing, it doesn't look that attractive from outside. You cut it and you eat it and it's still very, very good, right? So debt mutual funds continue to be very interesting in that sense. So what do we think? Just to summarize, first of all, you have to remember that it is only an impact if you're in a 30% tax bracket. If you're in a 10% or a 20% tax bracket, nothing is really changing for you. In fact, if you are in a 10% tax bracket, FDs are going to be taxed at 10%. That is better. You don't have to pay the 20% from mutual fund anyways, right? So if you're in that highest tax bracket, and we all want to be in that highest tax bracket, you definitely will have an impact, as I showed you in the calculations also. There is something called arbitrage funds, and that is going to look very interesting for many. You will see a lot of advisors and a lot of distributors will talk about arbitrage funds now. But do remember that arbitrage funds is subject to opportunities available. They do something called as cash futures arbitrage, and that's subject to opportunities. And there are times when if there is so much money going into arbitrage fund, they will not be able to capture that opportunity. And a lot of money then lies in liquid funds, and there is no real impact of arbitrage coming to you. Arbitrage funds are taxed as equity. So there is still a tax advantage for it. But again, the pre-tax returns itself could be affected if all the money goes into arbitrage funds. So it is better option than FD from a taxation point of view, but the pre-tax yield may be getting affected because of the opportunities that could be not really available going forward. Now, this is very interesting. This has always been the case. It's not like something has changed because of the change in norms. Buying bonds directly is always a very interesting proposition because there is a lot of tax advantage in that. So if you're buying a listed bond, a bond which is listed on a stock exchange, the moment you cross a year, it is treated as long-term capital gain. That as of now continues. Going by what the government is trying to do, if they're saying mutual funds and FDs both are interest income, why should I tax it separately? The same logic they should apply to bonds also. But as of now, that amendment has not come. But till it comes, you will get an advantage because in listed bonds, after a year, there is a 10% tax only. And in unlisted bond also, the tax rate is only 20% after a holding period of 3 years. So there is a 10%, 20% rate as compared to your highest tax slab of 30. So bonds, if you can buy directly, will always now have an advantage. And again, you will see a lot of NCDs by all these NBFCs being suddenly looked at as very attractive. I'll tell you what is the tricky part. Now, this tricky part was always there, and that is why in House of Alpha also we did not really recommend a lot of direct bonds. One is the ticket size is higher usually. In debt mutual funds, you can invest like 50,000 rupees also, 1 lakh rupees also, right? In bonds, depending upon which bonds are we talking about, when it comes in, private placement form, etc., the ticket size could be higher if it is available. So it could be 10 lakhs or 25 lakhs in some cases. If you're trying to buy it from the open market, which is, let's say, exchange or the RBI retail portal, which is a direct buying portal, the liquidity is a problem. I mean, you don't really get a lot of trading activity to get in and get out importantly. So you may still get in over a period of time. You can accumulate over a period of time and say, okay, I'll buy a 25 lakhs bond portfolio over the next 1 month. But when it comes to liquidation, when you want to sell, if there is no liquidity, you may be getting stuck in these direct bonds, which was never a problem with mutual funds. So it was always attractive, but the two problems, which is high ticket size and liquidity issue, if they improve, definitely we will also be considering advising buying bonds directly. Uh, Considering the interest rate scenario that we are in now, and in any case, we have been advising debt duration funds in the range of 4 to 5 years for the last almost 6 months. We have been doing that. Now, because of this 31st March deadline, so to say, it makes a lot of sense that if you have planned to make some investment in debt funds, do ensure that you do it before 31st March and ensure and enjoy that indexation benefit. But please remember that if you are interested in enjoying the indexation benefit, you preserve it also. So let's assume you were allocating 25 lakhs or 50 lakhs or any amount to a, let's say, banking PSU debt fund, for example. So you had an FD money. You thought, let me use that money and invest in banking PSU debt fund, and you will hold it for 5 years, for example. You will get about, let's say, 7-8% pre-tax yield, and that is what you're looking for. Now you invested in it on, let's say, 29th of March because you wanted to do it before 31st March. And these units now will get indexation benefit also. Now, you have to be very careful about one thing now, that let's assume after 1st April, you got some liquidity, you got some lump sum money coming from somewhere, and you're not very sure whether you will hold it for what time frame. Don't add this money into the same funds units. Don't buy units of the same fund again. If you do so, what will happen is you already have made an investment before 31st March. Then you add the surplus money that you got after 1st April. Now you have a total portfolio of whatever. And then let's assume that in few months you redeem this part. So in your head, you're redeeming this excess that you had added. But capital gain tax works on FIFO, first in, first out, which means the income tax authority will say the redemption that you made is from those original units you had purchased because that was the first you bought. They will assume that is the first you sold. So what will now happen is you bought it on 29 March. The redemption is happening, let's say, in few months. And what was supposed to be your long-term indexation benefit wala units, that is now going to be assumed as redeemed. And that's it. Now, the new units, even if you hold it for 10 years, there is no indexation benefit. So to preserve this old unit, because if you bought it for indexation benefit, keep it in a separate demat or keep it in a separate folio and ensure that you don't kind of pollute it with a lot of new investments that you make. You preserve it, make sure those units cross 3 years, which will happen anytime. And then when you redeem it, you will get the indexation benefit. So if you're saying before 31st March, I want to capitalize on it, do it, but also ensure that you preserve it. As always, if you have an investment plan, what happened as an amendment does not change much. I mean, as I said, we are not recommending debt funds just because there was an indexation benefit. So anything that you have made as a plan, please stick to it. We will keep reviewing it. This is more a information video that I thought we should send out because there is a lot of talk about it. So you would probably be confused about what to do. Honestly, nothing except that second last point I mentioned. If you were considering some investment in debt mutual funds, do it before 31st March so that you will preserve that indexation benefit. And also, as I said, be a little careful about how those units are preserved. Otherwise, you may probably lose out because of the FIFO, first in, first out logic. I hope this was useful. Thank you so much.